So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to The Daily Call from Option Alpha. Hey everyone, Kirk here again at OptionAlpha.com. Welcome back to The Daily Call. Today, we are going to be looking at the differences between long stock, long call spreads, and leap options, especially if you are insanely bullish on a particular stock or particular ETF. This actually came in from one of our members in the Option Alpha community. So thank you guys again for submitting questions, because this does really help me kind of figure out what you guys are interested in. And I would have not necessarily put all these topics together in one quick little daily podcast, but this is what we're doing because this was a question from somebody. And they were particularly interested in this because they are super, super bullish for whatever reason on Apple. And not that I'm not, or the other way, I'm just, they're insanely bullish. So the question becomes, what do you do? Well, I think it really comes down to just trade-offs and just understanding what the differences are. So the first one is long stock. Now, long stock has the ability to immediately take advantage of the stock price. So if you get in at, say, 160 on Apple and Apple goes above 160, great, you're starting to make money. But stock is super, super capital intensive. So in the case of Apple, if you're going to buy 160 shares or 100 shares of Apple at 160, it's basically going to cost you, about $16,000. So that's not a small nugget to basically outlay out of your account. The benefit to stock, obviously, is that you obviously maintain all of the exposure to the upside with all of the downside exposure to stock, obviously, but you can collect dividends along the way and basically be paid for your position. You can sell covered calls against it, which we didn't necessarily mention in the show title, but that's a possibility. The other thing that you can do is you can do a long call debit spread. So you can buy an in-the-money option and then sell an out-of-the-money call option and basically do a spread. Now, I would prefer, given all of these choices, if I'm super long on something or super bullish on something, I would prefer to do the spread versus doing any of the other two options. The reason is because even though you cap your upside potential, you can basically cap your downside potential in a debit spread, and you can get your break-even point close to or right where the stock is trading. So we all know it's insanely hard to truly predict where stocks go. So why not get your break-even point very, very close to where the stock is trading? So in the case of a long debit spread, you might do, say, a debit spread that's, 1 year out or 2 years out, however far you want to go. You might buy the 150s and sell the 170s, and your break-even point might be right around 160. Okay, so again, buy the 150 calls, sell the 170 calls. It reduces the cost of the 150 calls that you bought. And again, your break-even point might be right around 160 as well. So now you don't keep all of the upside potential. So Apple goes much, much higher than 170. Then you still obviously give up some of that upside potential, but you have much less downside risk, and you have effectively the same probability of success as you would holding long stock. Okay. The other way to go about it is to do what are called leap options, which are basically just option contracts really far out into the future. The example that I gave, if they're out a year or so or 2 years out, those are probably considered mostly leap options. In the case of Apple right now, I'm actually looking at the chart right now, or the pricing table. You can actually buy options out to January of 2020 right now. So it's about 700 plus days out, which is actually pretty far. So, that's, over 2 years or so, very close to 2 years or so out in the option contract pricing table. So in that case, those option contracts are going to be definitely more expensive because you're locking in a much longer time period for somebody to either make money or lose money on that contract. And that means that if you buy those contracts, you really, really should hope that Apple goes dramatically above that price point in the future. In the case of our example here, even if you bought the at-the-money contracts on Apple at 160 right now, for January of 2020, those contracts cost $25 a piece. So it's still about $2,500 a contract per contract that you get into. So it's less capital that's required than if you went with long stock. That's why stock is so inefficient. But you basically need Apple to move above 185 at the least before you start making money in 2020. So again, it's a huge, huge move that Apple needs to make. Not that it can't make it, but it's got to go up at least $25 for you to start to make money by the time expiration rolls around. So the goal here, again, is just understanding, just trying to figure out where these different things fit into, your assumption of where the stock is going to go, your capital that's required. Again, I think that the long stock option is probably the most inefficient way to go. You could definitely do the long leap contract or do something like a leap spread sometime in the future and try to replicate most of what you're trying to accomplish with your stock position without actually having to buy the stock outright. So hopefully this helps out. As always, if you have any comments or questions, let me know. And until next time, happy trading. Thanks for joining us on the Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on the Daily Call from OptionAlpha.com.